Welcome to the Deep Dive. We're here to give you the edge, breaking down complex company updates. Today, we're getting into Darling Ingredients' second quarter of 2025. It's quite a picture. You've got this core business doing really well, while their big renewable fuel venture, Diamond Green Diesel, is navigating some serious regulatory headwinds. How is management handling this? What's the plan? That's what we're digging into, the key insights you need. So let's kick things off with the headline numbers from Q2. Combined adjusted EBITDA landed at $249.5 million. Total net sales were $1.48 billion, a slight bump year over year, and gross margins improved up to 23.3%.
Right, but what's really interesting, I think, is if you look closer, that combined adjusted EBITDA, it was down a bit from last year, but here's the thing, if you actually pull out Darling's share of Diamond Green Diesel, DGD, their core ingredients business, its EBITDA actually improved pretty significantly to around $207 million.
Okay, so that's the split you mentioned.
Exactly. Sets up this clear narrative right away. You've got a really robust core business, resilient, and then you have the fuel side dealing with a tough environment, though maybe, just maybe, starting to see some light. Management definitely emphasized that core momentum. They see a positive path there.
Okay, so let's unpack that core ingredients business first. Management sounds incredibly bullish, saying it's as exciting as it's ever been. What's driving that excitement?
Well, you can see it in the feed ingredient segment numbers. Sales climbed to $936.5 million. And gross margins, they improved nicely to 22.9%. The main driver there, interestingly, was rising fat prices.
Batch prices.
Yeah, and significantly helped by recent public policy changes favoring domestic sources. That gave them a real boost. Now, protein prices, on the other hand, they felt some pressure. Tariff volatility, more domestic oilseed crush, that pushed them down. But the strength in fats mostly made up for it. Yeah. They did mention something they called a lag effect in Q2, though. Basically, the cost of their raw materials went up faster than they could adjust the prices on their forward sales contracts.
Right, so costs rise, but the selling price is locked in lower for a bit.
Exactly. It squeezed margins temporarily, but they expect that to ease off as prices sort of level out. And they're already seeing Q3 fat prices up, 10 to 14 cents a pound compared to Q2. So positive signs there.
That makes sense. Now, sticking with the core, but shifting a bit the food segment and this move into health and wellness with Nextitan, that sounds like a big strategic step.
Oh, absolutely. The food segment itself held up well, healthy margins at 26.9%, and sales volume actually increased to $386.1 million. That points to good global demand for collagen and gelatin. But yeah, the real headline grabber is Nextitan, this new joint venture in health and wellness.
It seems like more than just dipping a toe in.
It really is. It aligns perfectly with their strategy to push into higher margin, higher growth areas. They're leveraging what they already know about proteins and fats. Management talked a lot about the synergies geography, getting access to critical capacity, especially for hydrolyzed collagen. They're wrapping up validation for a glucose control product, Nextitan GC. Early results sound promising. They're even getting repeat orders already. Repeat orders are always a good sign. Definitely. And they hinted there's more in the pipeline products for memory, gut health, women's health. The ambition here, according to management, is huge, potentially doubling earnings in this part of the business in, say, 3 to 5 years. They expect a material impact starting in 2026 and really meaningful contributions by 2027. Significant play.
Okay, that does sound ambitious, but then let's look at the other side of the coin, as you put it. The fuel segment, DGD, still facing challenges this quarter. What were the main issues?
Yeah, that's where the numbers look quite different. Darling's share of DGD's EBITDA is only about $42.6 million. That's way down from last year. It just reflects how tough the renewable fuel market is right now. A couple of big things are impacting it. One is the overhang from small refinery exemptions, the SREs, waivers letting smaller refineries skip biofuel blending. That cuts demand.
Right. Less mandated demand.
Exactly. And second, there was uncertainty around the delayed enforcement for the 2024 Renewable Volume Obligation, the RVO. That's the national mandate. When enforcement is unclear, it creates volatility. Things were tough enough that they kept their DGD-1 plant offline, waiting for better margins.
Right.
And DGD-3 has a planned turnaround scheduled for Q3. So, yeah, a significant impact.
Given all that, management still seems confident about DGD's long-term value. Are they just being optimistic, or is there a basis for that confidence despite the regulatory fog?
That's the million-dollar question, isn't it? But they do point to some potential tailwinds coming. They mentioned the feedstock supply chain rebalancing, partly due to tariffs and regulations, which actually helps Darling's core business supplying DGD. So that's a positive linkage. On the demand side, they expect California's LCFS program, the Low Carbon Fuel Standard, to strengthen. Recent CARB changes are tightening the market for those credits.
Higher credit prices would help DGD's margins.
Precisely. And then nationally, the proposed RVO framework could be a major boost if the final mandated volumes, after accounting for SREs, are close to what's proposed. The timing of the SRE announcements is still a big unknown, but management seems to think the overall RVO is large enough to handle whatever adjustment comes.
So the lowered guidance was really just about when DGD recovers.
That's what they stressed. It was timing uncertainty in DGD, not a problem with the core business performance. Their plan is to have DGD ready for full utilization in 2026. They're anticipating a much stronger margin environment once all these policy rules finally get clarified. They also touched on the 45Z tax credit for sustainable aviation fuel, SAF. Changes there mean SF will likely need a higher premium over renewable diesel to make sense financially. Adds another layer.
It really highlights how much policy dictates fortunes in that segment. Okay, let's shift gears to financials. They seem very focused on financial discipline and the balance sheet right now.
They definitely are. They hit some key goals there in Q2. Successfully refinanced and upsized their Eurobond $750 million fixed at 4.5% for 7 years. Good move. They also paid off old credit lines and put in place $2.9 billion in new facilities, including a big $2 billion revolver.
And the cost of borrowing.
Remarkably, they managed to keep their average cost of borrowing pretty much unchanged while getting more flexibility, which is quite an achievement in this rate environment. Net debt came down to $3.89 billion, and their leverage ratio improved down to 3.34 times from 3.93 at the end of last year.
Significant improvement.
And they were very clear. Paying down debt is a top priority. The goal is to get that leverage below 3.0 times by year end. It shows a real focus on shoring up the balance sheet.
So with that focus on debt, what does it mean for spending, especially with growth ideas like Next Titan or maybe future DGD expansions?
Well, CapEx numbers reflect that discipline. Only $71 million in Q2, $134 million year to date. That's tracking well below their target of $400 million or less for the whole year. They made a point of saying they're not capital starving their assets, but yes, they have consciously delayed some growth projects to prioritize getting that debt down.
Makes sense.
Looking out to 2026, big decisions like, say, building a second SAF facility, that's completely on hold. It depends entirely on getting policy clarity and seeing a much better near-term margin outlook, which, they said, isn't the case right now.
But Next Titan fits in.
Perfectly. Because it's largely a non-cash deal for them. It gives them access to that health and wellness growth without needing big capital spending up front. It aligns exactly with the current strategy. Strengthen the balance sheet first, then look at other growth or maybe shareholder returns like dividends or buybacks down the road. Very disciplined.
Okay, pulling it all together then. For you, our listener, what's the real bottom line here? What's the key takeaway from all this?
I think the key takeaway is this clear split. You have a core ingredients business that's not just solid, it's accelerating, driven by good fat prices, plus this really significant potential from the Next Titan venture. And you contrast that with the fuel segment, DGD, which is facing these headwinds now, but it's fundamentally a strong asset just waiting for the regulatory fog to lift the RVOs, the SREs. Now look at their full year guidance. $1.05 billion to $1.1 billion in combined adjusted EBITDA.
Right.
Here's the fascinating part, and maybe the core insight for you. They explicitly said they expect the core ingredients business alone to contribute $900 million to $1 billion of that total.
Wow, so almost the entire guidance range is just the core.
Pretty much. It implies that any significant recovery in DGD, once that policy clarity comes, could push the company well above the high end of their current guidance. It really frames it as a timing issue for a good asset. Management even joked, I've never made a bad trade, but I've lost a fortune in timing.
Ah, that sums it up.
Yeah. So the opportunity might be that the market is undervaluing the core strength because it's so focused on the temporary regulatory issues clouding DGD right now.
All right, that brings us to our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea, hedge fund style. What have you got?
Okay, so leaning into that core strength versus DGD timing narrative. Here's a thought. This is purely conceptual, mind you. Given that clear split and management's own comments about timing being the main issue for DGD, what if you wanted to position for that policy clarity, eventually unlocking DGD's value? You might think about, say, a longer dated option strategy, maybe something like a long call spread going out quite a ways, perhaps into early 2027.
Betting on the 2026 recovery timeframe they mentioned.
Exactly. You'd be betting that by then, DGD is running full tilt. Margins have recovered because the policy fog is lifted, and the market has re-rated the stock to reflect DGD's full earnings power. Maybe finance part of that longer dated call by selling a shorter dated one, perhaps late 2025 or early 2026, closer to the current price.
So capture the potential upside from the re-rating while managing the cost a bit.
Sort of. It's positioning for that eventual resolution of the timing unknowns, allowing the market to value DGD properly while acknowledging the near-term murkiness. It's less about the day-to-day noise and more a strategic view on that policy trigger unlocking value. A bet, like the CEO hinted, on the sun coming out in 2026 and trying to get position before everyone else sees it clearly.
Interesting angle. Okay, that wraps up our deep dive into Darling Ingredients Q2 2025 earnings call. We've covered the impressive strength in the core feed and food businesses, the strategic potential in Next Titan, and that anticipated policy-dependent turnaround for the DGD fuel segment.
And just a reminder, of course, everything discussed here is for informational purposes only. It's definitely not financial advice. Please always do your own research.
Absolutely. So as we finish up, here's a thought to leave you with. In today's world, with so much information flying around, so many policy shifts, how much real value gets hidden, how much is just sitting there in companies like Darling, waiting for the market to catch up, waiting for policy certainty, or maybe just, as they said, waiting for the timing to finally be right? Something to think about. Thanks for joining us on the Deep Dive.